Yes, we can start now. So again, welcome to this webinar. Today, we'll be exploring the role of fixed income or debt in asset allocation. So why should you follow an asset allocation approach, right? That's the first thing that many people will ask. If equity can give me, long-term returns, then why should I follow an asset allocation approach? So this chart shows the annual returns of a diverse set of assets for about the last 22 years. So if you look carefully, you'd notice that no asset class has stayed in the top three for more than 3 years in a row, right? So GSECs outperformed in 2016, small caps outperformed in 2017, and both underperformed severely in the next year, like in the subsequent year, right? And if you look at gold, gold was at the bottom in 2021, right? But it again went to the top in 2022. So what does this show us? This shows us that markets are cyclical, right? And we should be very careful not to, follow returns, right, or act with a hindsight bias. And what works today may not work tomorrow, right? And diversifying is very beneficial in the medium term. Right. So let's look at some of the benefits of fixed income, like the role that fixed income can play in a multi-asset portfolio, right? So the returns from fixed income are less volatile than returns from equity. Most of us know this. When equity is, pretty expensive or very volatile, right? An allocation to fixed income can provide, the diversification that the portfolio needs, right? And also quite a bit of stability as well. So again, diversification is one of the most important aspects in a multi-asset portfolio. So usually when stocks are volatile, asset classes with a negative correlation to stocks, which means when stocks go down, asset class with a negative correlation goes up, right? Or stays the same, right? So, and these asset classes include, bonds as well. So they tend to hold their value and they tend to reduce the overall portfolio volatility, right? And this goes hand in hand with another important aspect of a multi-asset portfolio, which is capital preservation. During volatile periods, right? An allocation to fixed income can help stabilize the overall portfolio, right? And you reduce the impact of volatility on the portfolio. And again, this is crucial for the liquidity aspect. So when you switch from equity to fixed income, it will give you enough leeway to go back into equities when equities are attractive again, right? And this would enable you to optimize your returns while you manage risk as well. So, in short, to summarize this slide, your portfolio exposure is reduced in the equity side when equities become expensive, and then you row through the volatility with fixed income while earning a decent yield. And when um, and when and when equities were attractive again, you went back to equities from fixed. Right? So this will give you. Oh, sorry. So this will give you a better idea of how fixed income works in your portfolio. So this chart shows the performance of equities and fixed income in Canada during various periods. So this is not completely relevant to us here, but it's a good slide to show you how asset classes behave, right? Um, and so if you see, this really illustrates the point during various cycles where an allocation to fixed income could have benefited the portfolio, right? And during most of the cases shown here, like the tech bubble, the GFC, right, and the 31st December sell-off, right? So during all of these periods, there was some sort of a bubble in specific sectors, right? And it was plain as day that the valuations were on the expensive side. And as you can see, the gray line, which is fixed income, uh, remained relatively linear throughout. right? So it would again show you the benefit of switching down when valuations become expensive, and then when assets become cheaper again, going back into equities would enable you to make that now this would hit closer to home. So the equity line is the rolling returns over a 19-year period of the Nifty 50, right? And the bond line is the same metric for a 5-year Indian government bond, right? And this is a constant maturity bond. So the bonds maturity is always 5 years, right? And as you can see, the variance in of returns in equities can be offset with an allocation to fixed income at the correct point in time. Now, this is a question we get a lot. So, are we at the interest rate peak today? Right. So, where are we in today's fixed income cycle? So, let's look at two aspects. Let's look at the US and let's look at domestic fixed income. Right. So, in the US, your inflation is still above tolerance. The Fed's mandate is a 2% inflation rate. And even today, we're still at near around 4.5%, right? Now, this may not sound like much, but this is way off target. Like inflation is almost double what the tolerable amount is, right? Although it's softened slightly from you know, uh, I mean, not slightly, it's softened significantly from where we were a year and a half or 2 years ago, right? There is still a long ways to go with respect to, the PCE metric and wage inflation. PCE stands for personal consumption expenditure. That's what the Fed uses as a measure of broad inflation, right? So again, PCE and wage inflation are still above target, right? And to this end, the Fed has paused on rate hikes, although now the expectation for further rate hikes is still there, right? So they call that the dot plot, and that's still factoring in another 0.5% hike before the end of the year based on the data that they receive. So this may be in the form of like probably two more interest rate hikes, right? So now, when we come to India, India is a different story. Our inflation mandate is 4% with a leeway of 2% on either side. So it's basically 2 to 6%, right? And we're quite well within this range. And to this end, the RBI has also paused on interest rates, but the commentary from the RBI has indicated a little bit of caution, right? So with El Nino still, like might play a factor. So this does pose a risk of food inflation picking up again. If a lack of rainfall should affect the harvest season this year. So is this a good time to invest in debt? Right. This is another question that we get a lot. So all factors point out that it's a yes, right? If we look at gold prices, which is the other relatively stable asset when compared to equity, right? Gold is near its all-time highs. And if you look at real estate as another option, loan rates in real estate are also increasing, right, with interest rates. Equity markets, again, most recently this past week hit an all-time high, and it's getting increasingly challenging to find value in the markets, right? To find pockets of value. They're still there, but it's getting a bit more challenging at this point, right? And if you look at Indian fixed income, you're getting high interest rates, and we're still near the peak of the rate cycle. So, what is the opportunity today? So, your yield curve is quite flat, right? So what does this mean? This means that your short-term rates are not that far off your long-term rates. So by even when you allocate to short-term fixed income, you're still reducing duration risk and you're getting similar returns. Globally, growth is also slowing down, and growth expectations for next year are not, that rosy. And there are ample opportunities in the markets for things to turn choppy on the back of a bad earnings quarter or negative economic news. This is for developed markets, right? And to this end, the monetary policy from the Fed and to an extent from the RBI as well, right? It has been cautious, right? So again, to summarize here, um, we're near the peak of interest rates, right? Global growth does not look that great this year or next year. And there's opportunities for equity to turn choppy as well, right? And you would want some liquidity in hand at that point, right? If and when equities turn choppy. So now let me take you through Sphere's approach to asset allocation, right? So with Sphere, we can invest in ETFs, securities, and mutual funds, right? So we can take position wherever we see opportunities, right? So if we see an opportunity in a sector overall, right, we can just buy a low cost ETF and this will enable us to optimize portfolio returns, right? And if we want to say enhance the effect of a particular stock in that ETF, we can pair that ETF up with a stock. Or if we want to take a portfolio approach to a sector, um, but the ETF does not look that attractive, maybe in terms of weight, then we can pick an actively managed fund, right? And we can use that instead as a proxy for the sector, right? And your fixed income investments are done through mutual funds and ETFs as well. So why the basket approach, right, to fixed income? So this would enable us to diversify exposure to each security through the fund and take calls on duration as well, right? And again, this would enable us to leverage our expertise in fixed income advisory, right? And Sphere, when it comes to the asset allocation department, it's truly dynamic, right? So unlike most mutual funds, which you would see deploying this sort of multi-asset or in some cases a hybrid strategy, right? We don't have caps to any asset class, like no cap and no floor, right? This means that our decisions can be taken with conviction and we can invest based on the merit of the asset class at that particular point in time. And this is because we don't have any like limits on how much we can allocate. So if you look at, say, a hybrid fund, it might have a set exposure to equity and a set exposure to fixed income at all times. And, the leeway might be like only 20%, whereas we have 100% here. So I'd like to stop here. And yeah, if there are any questions, please feel free to put it in the chat and I will get to answering them. Okay, got a couple of questions. So which would be better, bond fund or a direct bond? Okay. So with respect to bonds, there is still you're still taking exposure in a single security, right? So you need to see whether you're comfortable with the credit rating and also like the balance sheet in general, right? And also you'll need to see like the interest that you're getting with the bond and also the liquidity aspect. So what we generally tell people is that if you're looking at say uh, uh, 5-year bond, right? Make sure that your investment horizon matches with the bond because when you're buying and selling direct bonds, the liquidity aspect of it is still a question, right? And again, that might come into effect if you want to sell early. So make sure that your investment horizon matches with the bond, right? And then you can take a decision on whether you want to go with a bond or not. With respect to mutual funds, it's relatively easy. Your duration risk is the average duration of your overall portfolio, right? And you get an indicated yield, and it's also very, very liquid. So if you sell today, you get the money back tomorrow, right? So it's a 1 day liquid cycle. And second question, for long-term investments, is equity still attractive? Yes, sir. Equity will always be attractive for any long-term investor. Um, Again, that is uh, broadly the best option available to long-term investors. But um, equity, the broader market is expensive. There is still value to be seen in particular pockets in the market. But overall, the markets do look a little bit frothy right now. But again, yes, for any long-term investor with say 5, 6 years, equities would still be attractive. But again, we would exercise caution at this point. Um, Perhaps you might want to invest a little bit more slowly, like pace it out a little bit more. Is a stock SIP good? Yes. Again, that also depends on the valuation. So if you mean I don't know what exactly do you mean by a stock SIP. If you mean investing a particular amount of money every month in a stock or a group of stocks, then yes, it is a good option to be looking at. Okay, the mode of charge in Sphere. So there are no performance-based fees. It's only a fixed charge. It's 1.5% per year plus actuals charged every quarter. Is it better to invest in a pool of direct stocks rather than investing in index funds or any active funds? Um, Again, it depends on where you are as an investor. So if you're not very experienced as an investor, then it's always better to go with a portfolio-based approach, right? Because again, like things are when you take a portfolio-based approach, uh, largely things are out of your hand, like out of your responsibility. So when it comes to managing a pool of direct stocks, you have to be very careful with the weightages and how you balance the portfolio, right? Suppose you miss out on doing this aspect. Um, one part of your portfolio would be much larger than the other part, and this could play a factor in imbalancing the portfolio as well. And index funds are very cheap. active funds offer a little bit of difference from index funds, right? So you have a lot of very good options to be looking at. Like it's not necessary that every investor for that extra bit of alpha should go into direct stocks. Like that might have been the case years back, but now with like the plethora of options that you have, right? It is very feasible to create a sizable amount of wealth just using mutual funds and index funds. I am a long-term retail investor, investing in stocks for the past 5 years. Portfolios 30% profits. Yes, at this point, I would suggest that you book profits partially. Um, and we can't, say that without looking at the portfolio. It again depends on the stocks that you own. Like some might still be cheap, some might be very expensive, which you might want to consider exiting fully, right? That aspect I might not be able to tell you during this call, but we could connect after the call and yeah, we could take it further. Okay, please explain ETFs. Okay, so ETFs are the term ETF stands for Exchange Traded Fund, right? ETFs are traded on the exchange, like NSE, BSE, like all the stock exchanges, right? And it's like a mutual fund in the fact that it's a basket of stocks, right? Um, so ETFs are there for various different strategies. So if you want to play a Nifty 50 strategy, there's a Nifty 50 ETF. If you want to play tech, there's the Nifty IT ETF. If you want to play pharma, there's a Nifty Pharma ETF. And most of these have some of the largest companies in the sector, or in the Nifty 50's case, just the Nifty 50 index, right? And these are balanced as per index weights. And yeah, so they're traded on the exchange. So it's like you're basically buying the bank Nifty or buying the Nifty or buying the Nifty Pharma index. So those are ETFs. And also, if you want to know the difference between ETFs and mutual funds have a more active role in managing the portfolio. So they won't have the exact weights as the index, right? And that's why ETFs are relatively cheaper than mutual funds because you know mutual funds charge you for the active management, and that's the value add that they will add, right? So yeah, that is an ETF. Okay, there's a mutual fund called the Asset Allocator Fund from ICICI and Kotak. How does Sphere's approach differ from it? Okay, so if you take a look at the Asset Allocator Fund, that is a fund of fund, right? So the Asset Allocator Fund invests in um, different mutual funds and ETFs, right? Whereas we invest in securities as well. Like we invest in direct stocks, and for a large part of the portfolio now is concentrated in direct stocks. And there's also ETFs and mutual funds. So um, and again, we don't have any like limits with respect to asset allocation, right? So if I want to take debt to say 5%, I can increase it to 10%, I can increase it to 30, right? And then like a few months later, if equity corrects, I can bring that 30 down to again zero also if necessary, right? So I have the option to go from 0 to 100 in three different asset classes, and also in direct securities, ETFs, and stocks as well. Okay, please distinguish sphere from I thought. Okay, so I thought PMS is a PMS house that manages four different PMS strategies. Right, one is a multi-cap strategy, it's called volatile. The second one is a pure large cap strategy, which is True Blue. The third is a small and micro cap strategy, which is Vritti. And the fourth is a multi-asset strategy, which is Sphere. So I thought PMS is the parent house, is the is like the fund house, and Sphere is one of the funds managed by I thought. Okay, how do we identify the best mutual fund? Um, Again, it all depends on what the fund manager is doing, right? So you need to look at which sector you're investing in. So people often, do not uh, take into account the sectoral weights of a diversified fund or the sector that they're investing into when it comes to a sector fund, right? So you need to look at the sector. You need to look at what the broad economic context is with respect to that sector. And again, there's a lot of work that goes into this. We talk to fund managers, get their views. We talk to industry experts, get their views. And again, we look at the funds from a qualitative perspective and also a quantitative perspective, right? And yeah, that is how we come up with, identifying like, a good mutual fund to invest. Okay, if we give 1.5% as fees in this fund, how much will the actual return be in the portfolio? Okay, so with respect to the fees, so the returns that you might have seen on social media for all of our PMSs are post fees, right? So we try to outperform inflation by say like 6 or 7%, right? So say if inflation is 4% today, we would like the target for the fund would be to reach at sort of like a 12% odd type of return, right? And that is generally the target for funds like this. Okay. Rates and sovereign gold bonds. Okay, so the rate market here is not very, very deep, but it's basically an easy way for investors to get exposure to real estate, right? And again, you have different sort of projects that might be offered, right? There might be projects under construction, or there might be projects which are already, ready and cash flow generating. And that's one of the important points in a rate, the ability to generate cash flows, right? That is one very important aspect to look at. Sovereign gold bonds are a good option if you feel that gold is not too expensive, or if you can, if you can find an opportunity where, like gold prices are also a little bit cheaper at a certain point, then a sovereign gold bond is a good option. Just make sure that it fits in with your time horizon again. But yeah, that 2% that you get with a sovereign gold bond, that extra 2% apart from the gold price appreciation, yeah, that is a really good option if it matches with your time horizon. Right. An important thing we have to check in a balance sheet before investing in the stock. Okay, so again, just reading the balance sheet is not enough to make an investment decision, right? You also need to go through what the company is saying, what the industry outlook is, what the what the outlook of the company is on the industry as well, right? But I can give you some of the more important things to look for in a balance sheet. That would be debt primarily, right? And also, with reference to that, you should also look at the profit and loss statements. Like you need to look at costs, you need to look at financing costs, which again ties back into the debt in the balance sheet, right? So there are various things that you need to take into account before taking a decision on a stock. Okay, equity being volatile for me to continue with my current mutual funds, what percent of return should I expect 1 year from now? What percent should my mutual fund return compared to that of Nifty? Okay, so during periods of volatility, right? We it's um, it's better that if we keep returns aside, right? Returns would always come to you in a bull market, right? But you won't, get the opportunity to invest, right? Like in a very large bull market. Whereas when periods are volatile, you get that opportunity to increase the size of your portfolio and again subsequently prepare it for a bull market, right? So that is the most important thing when you're looking at creating wealth over the long term. Like um, what um, what impact can investing during a volatile period give you, right? So again, I would suggest that you don't look at volatile periods from the perspective of returns. Rather, you look at it from a perspective of, okay, now markets are dropping. What can I do to, um, make my position more advantageous? Okay, in order to get a 5,000 rupees dividend amount, how much should I invest in stocks? It's 1 lakh. Okay. So 5,000 is 5% dividend yield. Yeah, 5% dividend yield. So again, depends on the stock. Like the dividend yield depends on the stock, but there are a lot more aspects that you have to consider before investing in a stock and not just the dividend. But if you're looking for a sort of like a fixed return option, then you can always look at the fixed income space again, like what we were talking about. So current yields across spaces is close to around 7.5%, right? If you want more details, we can connect one on one. But yeah, there are a lot of stocks that also offer a dividend yield. But again, stocks are volatile. So are you comfortable with seeing uh, fluctuation in sort of like how much your portfolio value is? That is also a question that you need to ask. Investing in mutual fund for ELSS. Okay, so if you have um, so for the ELSS funds, okay, for a fund review. Okay, so if you already have a point of contact with iThought, you can get in touch with them, um, and they'll be able to put you through to us, and me and my team would take a look at the portfolio. Right. So that is always an option. Like you can get in touch with your point of contact. Also, I have the contact details on the presentation. Yeah, the contact details are on screen. So, yeah, please feel free to get in touch with us. Um, can you quickly summarize the four funds under ithoughtpms? Okay. So there is Solitaire, right? Which is a multi-asset fund, right? And it's a pure equity fund. Uh, and that is the largest fund under ithoughtpms. There is True Blue, um, which is a fund that invests within the Nifty 50. So a pure large cap fund, right? Very good with respect to taking in corporate governance factors, valuations, and like broad aspects. Yeah. There is Vriddhi, which is um, a small and micro cap fund, right? Again, that is also it's a very driven process with all of the funds, right? We have a huge research team, we have a huge strategy team, right? So it's very research driven, the entire process. And the fourth fund is, of course, Sphere, which is the multi-asset fund, right? So we have we can invest in gold, silver, we can invest in debt, we can invest in equities, and we can invest through mutual funds, we can invest through ETFs, we can invest through securities, right? So that is for Sphere. And so, if you'd like to know more about these funds, again, the numbers on the screen, the email is on the screen, and the website is also on the screen. You could get in touch with us, and yeah, we could take this discussion further. Any more questions? If there are any more questions, just feel free to put it in the chat. Can I share the PPT? I am not sure if I can. I will check with the team, and if I could, then I can, I think you would have provided your contact details. I can get in touch with you, and yeah, I can share the PPT. I'll just check with my team if I can. Thank you, Mr. Jayakumar. Oh, thank you. Is there any limit for processing physical gold before investing in a sovereign gold bond? I'm not sure what the question entails, but if you're asking if there's any limit for sovereign gold bond, then yes, for individuals, I believe it's 4 kilograms per financial year. That's how much of SGBs that you can buy. For institutions like trusts and other things, it's 20%, I believe. I mean, 20 kilograms of gold. For individuals, it's 4%. Any more questions? I'll wait for a couple of more minutes. If there are no further questions, then yeah, we can wrap up. I'll be online for a couple of more minutes. Yeah. Okay, what's the difference between an active and a passive fund? Um, so an active fund will have a fund manager, um, and to take active decisions on the portfolio, right? So the fund manager has controls over the stock selection, over industry concentration. Like if I'm a fund manager, I can say that I want 20% of my fund to be concentrated in financials, 10% in pharma, 10% in technology, and I can work towards that allocation with like the stock selection and the weight for each stock, right? That is all under the fund manager's control. If you look at a passive fund is like say an index fund or an ETF, right? Say like an AMC, right? Looks at the Nifty Pharma Index, and they really like the pharma space. So, and they're not very particular on like the like the stocks within the index, right? They're okay with the index weights and the stock weights. And this again, this is based on investor demand as well. A lot of investors look toward ETFs these days, right? Because the index, like a lot of indices are well constructed within a certain context, right? Suppose the industry is at a cyclical bottom, then the index fund would do well for you, right, at that point in time. So again, if the index is pre-constructed and the weights are also predetermined, that is a passive fund. If the fund manager has active control over all of the decisions pertaining to that fund, then that fund is an active fund. What's the difference between a regular and a direct plan? Okay, so a direct plan is when the investor um, is able to invest without any advice from any like a like a financial consultant or a wealth consultant, right? Then they can go for a direct plan. Like if you know what you're doing, then yeah, by all means, like the direct plan is a good option. It's cheaper, right? Because you're buying it straight from the AMC. With a regular plan, the 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 intermediary gets paid by the AMC, but they don't charge the investor any fees. So the 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 direct plan is cheaper than the regular plan, but again, you're getting information, you're getting support, and to some extent, you're also getting education when it comes to investing in a regular plan. So that is the broad difference between a direct and a regular plan. Okay, a clarification on that question. How much physical gold can I process or own before I start investing in SGB? Okay. Physical gold has quick liquidity, but I also want to ensure that I don't invest more in physical gold. So is there a limit on how much percentage one can have as physical gold before investing in an SGB? I am not sure, sir. I will I will find out, and I can get one of my team to get in touch with you to clarify this. Yeah, and another oh, okay. So by physical gold, do you mean ETFs? Because you mentioned quick liquidity. Do you mean physical gold ETF or physical gold as in like bars and jewelry? But anyways, I can check on that. Okay, no ornaments, so the ETF. Okay. I am not sure about this, but I can check on that, and I can ask my team to get back to you. Yes, correct. Any further questions? Okay, so if there are no further questions, we can close the session. But if you have any more questions, like after a couple of hours or something, please feel free to get in touch with us. The email ID and the phone numbers are here. Um, and yeah, we can connect offline as well. So if you have any further questions, please don't hesitate. Please get in touch with us. And yeah, so very good, very interactive session. Yeah. Have a great weekend.